Since Saturday, the US and Israel have been at war with Iran. Supreme Leader Khamenei is dead. The Strait of Hormuz, through which 20% of the world's oil flows, is effectively closed. Barclays expects Brent at $100 on Monday. What does this mean for our portfolio? And that's exactly what we're going to look at now. Welcome to the weekly review. The week behind us was already volatile enough. BASF in permanent crisis mode. Stellantis with a historic loss. Novo Nordisk plunges after study data, and PayPal is hit by class action lawsuits. Everything is overshadowed by what has happened since Saturday. An open war between the US, Israel, and Iran. The impact on the oil market, on shipping, and on the overall perception of risk. And that will dominate this week. So let's dive in. What happened? On Saturday morning, the 28th of February, the US and Israel launched coordinated air and missile strikes on strategic targets in Iran. Operation names Epic Fury and Roaring Lion. Among those killed was Ayatollah Ali Khamenei, the spiritual leader of Iran. Nearly 50 high-ranking regime officials are now reported dead. A council of 3 is temporarily leading the country. Iran responded immediately with massive retaliatory strikes. Missiles on Israel, on US military bases in Qatar, Kuwait, Bahrain, Iraq, and Jordan. Even German armed forces bases in Jordan and northern Iraq are being attacked. However, all projectiles have been intercepted so far. An oil tanker was fired upon off the coast of Oman. Now, the crucial part for us investors, Iran has effectively blocked the Strait of Hormuz. The Revolutionary Guard is radioing ships that passage is prohibited. Several shipping companies, oil corporations, and trading houses have halted their voyages. LNG tankers are turning away. Satellite images show congestion outside ports like Fujairah. And what does that mean for our oil price? Brent shot up to $72.48 on Friday and was already at around $80 in Sunday's after-hours trading, plus 10%. Barclays sees Brent at $80 in the short term. Goldman Sachs warns of $100 to $120 if the closure persists. The Financial Times even suggests prices of $140 to $200. And that would be an extreme scenario. For comparison, the previous all-time high was $150 in 2008. Yesterday, on Sunday, OPEC decided on a production increase of 206,000 barrels per day starting in April. That sounds like a lot, but it's moderate and can't come close to compensating for the Hormuz shortfalls. 13 to 20 million barrels flow through the strait every day. Saudi Arabia has increased production and inventories as a precaution. My assessment, in the short term, this is bullish for everything related to oil and energy. And at the same time, the risk is also increasing. The Strait of Hormuz also affects LNG, meaning Flex LNG and the entire LNG sector. Hapag-Lloyd has already announced a war risk surcharge of $1,500 per container. This is positive for container rates, but bad for the global economy. What am I observing right now? How long will the Strait of Hormuz remain closed? That is the decisive factor. If it's days, it's a spike and a return. If it's weeks, it's a structural regime change in the oil market. Anyone holding oil and energy stocks shouldn't panic sell now, but rather wait and see the cash flows. If you're not invested, be careful, with FOMO buying at $100 oil prices. Now let's move on to the next block in shipping. There are record numbers here, and they are hitting right now, against the war premiums. And now to the sector that is most important for my portfolio, shipping. Two things are coming together here right now. We have strong quarterly figures from last week, and the Iran escalation. Tanker stocks are running like clockwork. DHT Holdings, Teekay Tankers, Nordic American Tankers, Flex LNG, all these positions have reached a 52-week high. International Seaways has exceeded Q4 expectations and announced a record dividend, plus a share buyback. And that's exactly what I want to see as a dividend investor. Operational strength, and that paid back directly to shareholders. In the dry bulk sector, Star Bulk Carriers beat Q4 2025 forecasts and is at a 52-week high. Although the stock dipped slightly afterwards, a typical sell the news effect. Diana Shipping presented Q4 and 2025 quarterly figures and announced a cash dividend, solid, reliable, just as I expect from such a stock. Regarding containers, Hapag-Lloyd has elected Carl Gernandt as the new chairman of the supervisory board. Much more important for us, Hapag-Lloyd has already announced a war risk surcharge due to the Iran escalation, $1,500 per standard container, $3,500 per reefer container for everything to and from the Persian Gulf. That is driving container rates up. Now let's bridge over to the whole topic of geopolitics. All these 52-week highs were reached before the Iran escalation. Since Saturday, we have a completely new situation. The Strait of Hormuz is closed. And that doesn't just affect oil tankers, but also LNG carriers and product tankers. At least 14 LNG tankers have already diverted or reduced their speed. An oil tanker was fired upon off the coast of Oman. Shipping companies have largely ceased their operations through the region. What does that mean for freight rates? If ships can't go through Hormuz, they have to go around Africa. And that ties up tonnage, lengthens routes, and drives rates up massively. That's exactly the scenario we saw with the Houthi attacks in the Red Sea, only this time on steroids. Because Hormuz is even more important than the Suez Canal. 20% of the world's oil and a quarter of the global LNG trade flows through Hormuz. My current assessment of the shipping sector: strong fundamentals plus a geopolitical risk premium that's very bullish in the short term. But be careful, if a quick de-escalation occurs, rates could fall just as quickly. I'm not selling anything, but I'm also not buying aggressively at these levels right now. Let's move on to the next block, which is BASF. Crisis without end. BASF was basically under a barrage of news this week. The quarterly figures came out, and it was what many had feared. The main plant in Ludwigshafen was identified as the only unprofitable site. 4,800 jobs will be cut as part of a tightened austerity program. Investments are being scaled back. EBITDA outlook for 2026 was lowered. The Zhanjiang plant in China is expected to be loss-making in 2026. At the same time, the sale of over 4,000 company apartments and the relocation of jobs to India. A dividend of €2.25 was proposed here. Stable, but the question is for how much longer. The analyst reactions speak volumes. JP Morgan with underweight and a price target of €36, Barclays underweight at €40. UBS at neutral with €48. Not a single bull case currently on the table. Now let's move on to Novo Nordisk. Novo Nordisk had a brutal week. The phase 3 data for CagriSema, the next big weight loss drug, was significantly weaker than Lilly's tirzepatide. The market reacted immediately. The stock has fallen massively. Then there's Novo, lowering US prices for Wegovy and Ozempic starting in 2027 and issuing a sales warning for 2026. That's a double blow. A weaker pipeline product and price pressure in the core business. What's positive? The FDA has approved Sogroya for 3 new pediatric indications, and the billion-dollar partnership with Wiftex for oral obesity drugs shows Novo is still investing. My current take: it gets interesting at much lower prices. The obesity market remains structurally a megatrend, but it's still too early to jump in right now. Let's move on to Block 5, PayPal. Class action lawsuits and takeover poker. PayPal remains a tragedy. The stock's been in free fall since the new CEO and the missed Q4 numbers, down 20% in one day from $52 to $41, and now the lawyers are coming. At least 3 law firms have filed class action suits over allegedly misleading statements about the branded checkout strategy and the 2027 goals. The lead plaintiff deadline is April 20th, 2026. At the same time, there are takeover rumors. Stripe is said to be interested in PayPal. The stock briefly jumped 6.7%, but PayPal is actively resisting takeover attempts. Jim Cramer says PayPal isn't doing well despite its cheap valuation. The term falling knife is being used more and more often. My assessment: given the class action lawsuits, I've become more cautious. The valuation looks cheap on paper, but the operational problems are real. I'm waiting it out here and just watching. If Stripe is serious, that could be a real game changer. Now let's move to Stellantis and that 22 billion loss. Stellantis reported a net loss of 22.3 billion euros, driven by massive write-downs on their EV strategy. The dividend is suspended, EV programs cut, the new course refocusing on the US market. The Jeep Cherokee is meant to bring the turnaround. This is a clear sign of how expensive a poorly timed EV bet can become. Not every car manufacturer will survive this transformation. What's my current take on this? You can look at this in the context of the entire auto industry. BMW with recalls, VW in labor court, Mercedes cutting jobs. The European auto sector remains under pressure. Now we come to the final block, which is more highlights in a quick rundown. Enel beats its 2026 profit target, raises the dividend, starts a share buyback, and puts 20 billion euros into renewables. Philip Morris record high at $190.98. Zin growth is driving a revaluation. Realty income, Evercore raises price target to $65. An $8 billion investment boost is planned. Equinor also at a 52-week high after strong quarterly figures. BHP currently at an all-time high. Copper boom drives profit growth. And Rio Tinto, record production in copper and bauxite, adjusted EBITDA of plus 9%. Nutrien 52-week high, share buyback is announced. Negative Diageo dividend was halved here, vague restructuring plan, and the stock is currently falling. Intel weak outlook, Q4 loss pushes the stock further down. Lufthansa flights to Dubai and Middle East cancelled. ECJ confirms cartel fines. Cityline pilots vote for strike with 99%. Bayer quick hit. Zofigo combination lowers death risk in prostate cancer. Positive, but stock barely reacts. Dufisat settlement over $7 billion is being blocked by law firms. Here I would wait and see for now, otherwise I would just say, let's take a very quick look at the dashboard. We currently have inflation of 2.39%, the Fed rate at 3.64%, money supply at 4.29%, unemployment rate at 4.3%, and currently a volatility of 19%. I'm curious how this will adjust after the stock market opens. Yes, otherwise we are generally at the macro assessment right now. In the entire raw materials sector, I'd say a green picture is showing through. Let's take a quick look at the sectors where capital is flowing in and out. Currently, it's going out of tech, into energy, out of financials, into industrials, materials, staples, health, utilities, and into REITs, as you can see. Exactly, and here again briefly mention what I had already said anyway. Currently, it's a common month for special dividend payouts in shipping anyway. And here too, we generally have increased chances for special dividends. And here we also have an increased chance for special dividend payouts. The coming week, so this week, will be extreme. Today, the stock markets open with the Iran war as the dominant theme. The three key questions. First, Strait of Hormuz, will it remain closed? Every day of closure pushes the oil price further up. That's good for energy stocks, but bad for the global economy and for import-dependent companies. Second, escalation or de-escalation. Trump signaled willingness to talk, but the Iranian retaliatory strikes continue. A 3-member council leads Iran. How stable is that? The next 48 to 72 hours will bring a signal about that. What am I doing in the portfolio right now? I'm definitely not going to rush into anything. Those with oil and shipping positions benefit in the short term. Defensive stocks like tobacco, telecom, and REITs remain the anchor. I'm currently keeping cash ready for panic selling in the broader market, and those often come with a delay. My basic rule in such phases, think in cash flows, not in prices. Those who hold solid dividend payers will also survive the crisis. What's very important for me to say again is that this is of course just an analysis of what's currently happening in the market. This isn't a political statement. These are simply the facts of how this is affecting the respective sectors. If this weekly review helped you, leave a thumbs up and feel free to subscribe to the channel so that you're back again next week. Tell me in the comments, how are you currently positioning yourself with the rising oil prices? Do you have energy stocks in your portfolio? Let me know how you assess the current situation where you might see the oil price going. Otherwise, I'd say the weekly review is finished for today. This is not investment advice, but just my personal strategy. Take care of yourselves and your capital. I wish you all successful investing. Until the next video.